Hello traders, Gary Wagner here. It is Monday, markets have closed, the 20th day of June, approximately 12 noon here in Honolulu, about 6 o'clock in New York, and what a week we've seen. This is a special edition of Chart This After the Show. It is a special report. Our basic topic on this report is how high do we think gold will go. It's a fairly detailed report. It is part of the daily and weekly review that I do for our paid subscribers, and this will give you a real indication about the kind of analysis we do at the Gold Forecast and see if it's something that would suit you and possibly make you a better investor and trader. To that end, if you notice when you look at the layout of the page with this video, what you're going to see is a written letter, some commentary, and the commentary is mostly fundamentally based. You will then see market forecast. Market forecast will highlight some of the things we'll talk about on today's show, along with what we're looking at in terms of our current forecast. Proper action below that is our current trades. That, of course, is a paid subscriber. They got trade alerts getting us in and out of the market with specific stop recommendations. I believe that not only do I want to provide you with trade analysis and actual recommendations with stop placement, in other words, guide our subscribers step by step in the process, I want you to understand the idea and the thought process behind it and the theories of what we bring into the type of analysis we do, so that not only are we going to fish for you, but I do want to teach you how to fish. With that in mind, please enjoy this special edition of Chart This After the Show. There's a subscribe button, and it will allow you to set yourself up for a free trial. You'll be able to get the daily report for an entire week at no charge. You really have nothing to lose. Please join us on the daily report. Here's our special report. Traders, what a week we've had in the market, considering that we've seen approximately a 3% gain over just this week alone in gold. We've had a phenomenal move, and we have broken through some really key levels. We're going to start today's show. We're looking at a 120-minute chart, and on this chart I've got a couple of different fib retracements, but we added this one in just recently. This is the first rally, which began back, about June 4th, in which we saw the market go from about 1241 up to a top at around 1281. Now, here's what's interesting. When we calculate a 61% retracement, which is what we've just done, look at this low coming in just at around 1258. So we had a tremendous retracement. The market takes off and then absolutely goes parabolic. Again, parabolic is one kind of a rally in which we'll see the market just take off, covers a lot of ground very quickly. The only thing about a parabolic rise is, as I like to say, with a rise you get a demise, so that when we get a market overheated and moving up that quickly, if the fundamental data that's been in the market changes, what tends to happen is we get that premium eroding out of the market very quickly. Now, the market trading at 1314.39, we saw it hit a low intraday last night of about 1305. The critical number to me, of course, is got to be around 1300. It's that century mark. If we draw a line across the screen as I'm doing now, we'll see that we do have a couple of series of tops that came in, and it was absolutely resistance at this area. At this point, we need to really see if it's going to remain as support. Let's draw that line in just a little bit straighter. There we go. Now, the market came up, went over the 1311 mark, traded back into it, but it is currently trading above that point. That to me bodes pretty well. We're going into a weekend, and the geopolitical uncertainty which has been present in the market is absolutely still there. It seems as though it will probably escalate before it gets any better. So traders, what are our current levels that we're looking at? And also realize we entered the market back from the long side. Traders that got in are in anywhere between 1301, 1303, maybe 1304. It was absolutely a fast market when we sent out the trade alert. I've basically compressed the chart that we're looking at to cover a little bit more ground so we can look at some key levels of current resistance in the market. These are short-term levels, of course. Now, we identified 1311. It's based on a Fibonacci retracement, and obviously it is something that I think will hold, and I believe that it's pretty important. As I said on chart this morning, 1300 is really that critical area. But as the market moves up, you can see this is that 1321 area right in here. And the question is, where does that derive from? And for the best that I can do, you can see this dashed line coming in. It's a light blue. And if we look at these areas right in here, April, say, beginning of the year, March, excuse me, we had these as being the lows, and then the market moves up and then comes back up and it makes another series of lows. And so to me, those are the areas that we want to look at. So obviously 1321, which is the intraday high, that's minor level of resistance. The next level above that is got to be based really on this particular top here. And when we look at this top, I believe that was 1331. And then this was around 1312, if memory serves me correctly. So 1331, that would be the next level, and then 1341. So those are the levels as we begin trading next week. Should the market continue its dramatic upsurge and rise, those are the levels that we want to be looking at. Now, in terms of stops, we have a very, very loose stop. Traders who've been with me for a while realize that what I typically do is put in some sort of a fail-safe stop, and then we adjust it as we analyze volatility in the market and range in the market. Because if the market is swinging around or kicking around with $20, $30 moves and ending up at a price that we assumed it might go to, one of the things that is very, very frustrating for us is to get stopped out only to see the market move in the anticipated direction. So that being said, we absolutely need to analyze this market. So right now, my sense or my thinking is that we want to place it below $13. $13.05 being the low, we'll probably put it at about $12.98, $12.96, $12.98. Of course, that would protect equity, not profits, because profits are above $13.03. So we've talked about really short-term interim resistance level. Let's make the assumption, it's a good assumption, but let's make the assumption that gold does continue to rise. Let's further make the assumption that we're able to break above these collective states, meaning first 31 and then 1341 right here. Where do we think the interim to longer term picture could take us? Well, obviously the mark that we need to take out is the high of the most recent rally. When this market, end of last year, beginning of this year, really had that dramatic price rise, $200 rally, it ended just below 1,400 per ounce at 1391. So after 1341, my sense is you've got this small little top in here at around 1350, but other than that, we had a pretty dramatic price move right in here. And when we look at that and compare it to this is one of the most straightforward parabolic rises I've seen because we had the $40 rise. That's what makes it so dramatic on an intraday chart. We'll look at some daily charts, but my longer term picture of where I think we could end up in terms of the market over the next couple of months, if this bullish scenario builds and maintains, is just below 1,400, and it's based upon this top that we hit back in March of this year following a $200 plus rally. So traders, we're looking at a daily chart. It has a simple moving average standard candlestick format in which we've actually added these resistance areas. Reason for adding them and spending a little bit of time is to see if we have some technical evidence historically that kind of backs these particular price points. Now, first of all, let's look at the intraday low that we had, 1305. I've simply drawn horizontal lines in which I've fixed them off particular price points. And on this one, I fixed it upon this particular point right in here because I saw some tops and a clustering of resistance right in this area. This comes in at around 1305, and we can see that that matches up quite eloquently with the intraday low that we had. Next level, in terms of the marketplace itself, I'm looking at this particular top here. We draw our eye across it. The only other area we see is here, and this would be around 1331. On top of 1331, the next real level's got to be 1360. 1360 is based on this smaller top here. This came in just prior to the market correcting and hitting that double bottom, 1180. We hit that twice. That has proved to be resilient and have a lot of support for gold. So 1360 and then 1391 on the upside. So in terms of our actual strategy for exiting the trade, we want to see, should the market continue to move higher, we absolutely want to see how it reacts at 1331, 1360, and 1391. Now traders, here's where you see dramatic differences between the Japanese average and standard candlesticks. Standard candlesticks, true opens and closes for the session, daily chart. On a Japanese average chart, we're fixing the midpoint of the prior day on a daily chart, and that's always going to be the bottom. So that's the reason that when we look at an uptrend, we want to see an absence of lower wicks, because what that's saying is the fixed point midpoint yesterday is a price point that we never traded into, and therefore is a little bit more bullish. We want to see large candles. Now, when you saw the small red candle for today's $5 lower move, look at how it converts to a Japanese average, because what it's doing is starting at the midpoint of yesterday and taking us to our current print. And so what you get is, rather than that small red kind of ominous candle, you're getting a solid green candle, because when it compares it to the midpoint of yesterday, it has dramatically moved off of that price. And that's what happens when you have that kind of a $40 move. Also, we're looking at these series of tops. This to me is an important level to close above. We talked about that, 1305. So I think that what we're seeing once again is, after this tremendous spurt, we're getting a period of consolidation. If you recall, we talked about the way this market has been moving up. Let's go ahead and convert it back into a standard candlestick. And what we really noticed, I mean, except for the dramatic move yesterday, let's go ahead and blow this up, is really the nature of the way we've seen this rally up till yesterday's dramatic move. Market came down double dojis. That really was our first indication, but we get this price hike or spurt, a resting period, 2 days where it consolidates, a price hike, a quiet day again where it consolidates, a price hike. You had 3 days of basic very small rate. Well, you had a large range, but the open to close was small bodied candles, so you get that sideways action. And now we've got this hike, and I believe we're seeing a little bit of sideways action as we go into the weekend. In other words, my sense for this market is I'm still overall extremely bullish. I think that the scenario that we are currently witnessing in terms of the geopolitical uncertainty in the Middle East, along with a rising sense of inflation, consumer price index moving higher, mentioned by the Fed, although it won't be for a while, that they are gearing up to raise interest rates. All crude oil prices have been moving up. All of this dramatically, to me, spells inflation. Inflation, of course, is a bullish factor for gold. So one of the things that I mentioned at the onset of today's weekend review was the fact that we see silver can be moving in sympathy, of course, with the equities markets. I've put up our Standard & Poor's 500 chart. It's a weekly chart, standard candlestick format. And you can see absolutely and dramatically the fact that we are now at a new high in the Standard & Poor's, meaning equities are at an all-time high. And we didn't get platinum and palladium following suit, but we certainly got silver. Let's take a look at the silver charts. Looking at a daily chart, standard candlestick format. Of course, when we take a look at it, you can see this dramatic 4% rise that we saw yesterday barrels through $20, doesn't find any kind of resistance until a dollar later, just shy of 21 or just above 21, 21.10. Currently trading at 20.84, just below. This small candle here represents today's trading. Unlike gold, which has a small red candle, we've got a small green candle. But just like gold, watch what happens when we convert this to our Japanese average chart. And here you can see the real dramatic difference. Long bodied because it compares it to the midpoint. That midpoint is quite a ways down from where the market is because it closed on the highs. We have a dramatic rally going on. Now, where are we pegging certain levels and what are our targets on our current silver trade? Of course, we're long silver, long gold. I have talked about this over the last couple of weeks, but when the market was sitting mid-19s, I don't think it had the same weight as me saying it now, but I believe that we've got a real distinct possibility of seeing $22 silver. Now that we're closer to 21, it doesn't seem that far-fetched, but this is what I'm basing it upon. Straightforward logic. When we had the rally back end of the last year, beginning of this year in gold, we really didn't get that same sort of action in silver. Look at this. As gold was moving up, silver was trading sideways, defined by, I believe it was about 2030, 2020 on the high, low being at around 19, and it was just caught in this just narrow band here in which it couldn't escape. Trader's nightmare, so to speak. But come February, end of January, we saw this dramatic spike hike, only to be followed by a slow demise to a low that was actually below these previous lows. When we do that, when we look at that, this is really the most realistic target that we have. There's really no trading activity in this above these tops right in here. Here we had pretty much a slow move. I don't see any levels of support and resistance here, nor do I see any levels of support and resistance in that price range here. And that's why I came out with my forecast of silver possibly moving to 22, because I believe I put it in the following way. Silver was in between these two price points is almost nowhere land. There's really no technical evidence to support resistance points, support points, and for that reason, I believe that if you break the inertia that was holding it back, which we certainly have, we could certainly see a dramatic rise and see it rise as high as $22 per ounce. This has been Gary Wagner, wishing you as always good trading. Have a great weekend. We'll talk to you on Monday for another daily update and review. Bye-bye.